On this episode, we talk about the future of finance with special guest Brian Mosoff from Ether Capital. Welcome to Think Heart. Okay.
I'm excited.
Man, I've been, you told me, Ben, you told me that we were going to have a special guest on. I've been excited all day. I've been surfing the web, as they call it, right? Just getting all the information. I got 100 questions down here, but before we get into that, we should introduce ourselves. I'm Scott Goodfellow. This is Ben Hart. We're the Hart Investment Group. You can find us on all social media platforms. Before we get started, why don't you, Ben, why don't you take it over there and introduce Brian?
Sure. Yeah, for sure. Well, look, I'm certainly excited to have Brian here. I've been following crypto now for a few years, but really investing in it for the past year and a half for clients and for myself. Certainly, the initial pull into it was Bitcoin, and I'd attended the Real Vision Crypto Conference about a year ago, and that was really how I started to kind of go down the rabbit hole, and Bitcoin was kind of the start. And then as Ethereum came into it, I started to have a lot of interest in it, try to understand it. Obviously, it was created by a Canadian, so that creates some interest as well. Brian is CEO of Ether Capital. So we're definitely excited to hear what about Ethereum, and I'm looking forward to hearing what Brian has to say, and we're excited about having him on tonight, and so looking forward to hearing from Brian. He's an expert in the field of Ethereum, and we're excited to hear about what it is, how it works, what are the practical implications, what do we use, and how do we use it. And so we're excited to see what Brian has to say. I think he's coming back on there.
I still see him. So let's keep going.
Do you still see him?
I'm right here. Do you want me to say thanks for having me?
Sorry, yep. Brian. I lost track of you there, but Brian, listen, I'm excited to hear what you have to say. I'd like to hear a little bit about your background. Maybe you can tell us a bit about yourself, and then we can dive into the hundreds of questions that we have for you.
Sure. So thanks, guys, for having me on the show. Always happy to chat crypto, Ethereum, all the stuff that's happening now in the future of finance, especially as it relates to blockchain. So I'll give you a bit of background on how I fell into the space. It actually was first about hearing, I heard about Bitcoin in 2012 through a random event. And I think like most people in the space, they first hear about Bitcoin and they have this idea of software or algorithmic based monetary policy and say, that's too crazy, that'll never work, but interesting idea. Mm-hmm. In 2013, I spent a lot of my time on Reddit, as I basically still do today. And you couldn't ignore that there was a passionate group of people who were talking in, at that time it was our Bitcoin, that were talking about monetary policy, game theory, distributed computing, science. And there was something happening there that it would just continually pop up on the front page. And so at that point, I decided it's time to do more reading and get smart on this and try and figure out what are these developers and people just so obsessed with. And it was clear that there was this community that was not going to let up on this idea. And so I really went down the rabbit hole in 2013. And Bitcoin is kind of the gateway where you start with that asset. And then at the time, there were other clones of Bitcoin, right? This is open source code. Anyone can go on GitHub and copy it and tweak around the recipe and redeploy it. And now you have Litecoin and Purecoin and Feathercoin and Dogecoin and a host of other ones. And the thing that really got me interested was first Bitcoin, but then being part of the Toronto group of people who would meet up every now and then. And we're not talking a lot of people. This is five people in a bar talking about how they matched the end of their Litecoin address to a Bitcoin address, and all of us thinking like that's really cool. And then this idea of Ethereum comes around, and so you've got this very basic programming language that's baked into the heart of Bitcoin that doesn't allow for a lot of flexibility or functionality to be built on top of it. And then you have this idea of Ethereum saying, let's borrow this idea of peer-to-peer value transfer and a trustless system. But what if you put a more functional programming language into that base layer? What happens next? And so that idea was really mind-blowing. And I actually have an email with a friend of mine talking about this kind of comparison between Bitcoin and Ether. And we're saying in this communication, this will be as big or bigger than Bitcoin if they can actually pull off what they're proposing here. So we were really excited about it from the early days, and I got to join that early Toronto Ethereum community, start looking at things that would be complementary to it, things that would be competitive to it, and that was it. I mean, you're in the rabbit hole. You're not leaving once you understand the technology and how this is going to change finance in the world.
Right.
Ether Capital was formed in 2018. I wasn't involved at first. I joined a few months later, and here we are. So my day-to-day is sitting at Ether Capital, an advisor to some of the regulators on good policy relating to cryptocurrencies and fintech, and mentor at a few different startups, and having the time of my life being in this space.
Yeah, it's an exciting time. It's an exciting space right now. Where did you come from originally? What was your background prior to going down the rabbit hole in this one?
So in my previous life, I used to work in film finance, but I've always been interested in technology. When I was 3 years old, I'd want batteries for a little tape recorder that I found in my parents' house, because I figured if you could plug a cardioid microphone into this input, you could see what it would sound like to record something. And so I've always been fascinated by what technology could do for you, what was coming next. Whenever the iPhone came out, I was the first one that I knew to get an iPhone. When you could get a Facebook account back when it was cool or even unknown, I wanted to be the first one to test that technology, to play with it. And so cryptocurrencies are just an evolution of my journey through tech. The design space here is so wide that it's kept my heart for a number of years. So I wouldn't really consider film or film finance really that related.
No, but sure, fair enough. But I think film will be interesting as we go to NFT and as we start the kind of the tokens and smart contracts, things like that. That'd be interesting to talk about at some point. But I've had we've been trying over the past couple of years to educate clients to try to understand too, and it's we both spend a lot of time trying to understand it, the crypto space, and it's moving so fast. And so I know that this might seem like this is basic stuff for you. Maybe you can tell us, and I know it's simple, but maybe you can kind of describe the differences between Bitcoin and Ethereum, maybe talk a little bit about the blockchain, and kind of maybe you can kind of give us the basics of it to help people kind of understand the difference and why it's so unique.
Sure. And so I think it's helpful to understand what Bitcoin solved in the context of computing science for people. And if you go back in time for 40, 50 years, there was this problem called the double spend that was thought to be an unsolvable problem. And essentially what this is in the real world, if I'm sitting with Ben on a park bench right now, and I hand you a $5 bill, you don't have to trust me in the transaction, right? The thing you trusted was the $5. You didn't have to know anything about me, my background. Doesn't matter. The $5 is the thing you trusted. No problem in the real world. When you try and map this same transaction into a computing environment, well, it all breaks down. And that's because computers are, of course, not about destroying or losing the sender's thing when it gets passed off to the receiver. You are duplicating the data. And so people can easily draw a parallel here to if any of us go on YouTube and you download a video, you don't for a second think that YouTube lost a copy of that video, right? They retain their copy. You just duplicated the data. And when you apply this to money, you have a problem. If you want to do a cash transaction on the internet, how do you do it without a third party? And the answer was always, you can't.
Right.
You need someone to facilitate the transaction, right? You need Visa, Interac, PayPal, Swift Network, Venmo. Someone has to sit in between, some intermediary. Not a solvable problem.
Yep.
Until late 2008, when a white paper gets published in the cypherpunk forums called Bitcoin, an idea for a cash peer-to-peer digital system. Exact wording might be slightly off from that, but you get what I mean.
Sure.
And they basically solve this double spend problem with this network design, with this protocol.
Yeah.
And a lot of people, I think, read that white paper who were extremely brilliant. We're talking cryptographers, people who understood all the math behind it and the computing science elements, and said, cool idea, it's never going to work.
Right.
That's okay, because they went ahead and wrote the software anyway. And January 3, 2009, you have the birth of Bitcoin. And so what you have at the core of Bitcoin is this network with some rules. It's a piece of software. We call it a protocol, but this blockchain is just a piece of software. And the software works where every certain number of minutes, it's roughly 10 minutes, a new page of the ledger gets created. It's called a block. And there's a reward for whoever proposes that page of the ledger. You could think of them as an accountant. They just happen to be running a bunch of computers and electricity, somewhere to do this work. And the reward for them to secure all those transactions and put them in a page of the ledger is newly mined Bitcoin. And what people like about Bitcoin is it has very simple rules. So we know that there's this 21 million limit that will ever be created in the system. We know every roughly 10 minutes what the reward will be per page of the ledger that goes to the miners. And we also know that every 4 years, the reward, it's a little less than 4 years, but in theory, every 4 years, the reward gets cut in half. So initially the reward was 50 new Bitcoin, then it was 25 new Bitcoin. And so what you have here is a very transparent monetary policy. And what people initially said, well, this is crazy, it's not backed by anything. What they were really questioning was, can you have software-based monetary policy? Is that good or bad? Different than the Bank of Canada, different than the Federal Reserve, where the monetary policy is not predictable. They can commit to something for a couple weeks, a couple months, a year. They can target something, but no one really knows 5 years down the line what it's going to be. What people liked in Bitcoin was, why should we have 10 individuals in one geographic location with a political agenda deciding what the money supply is going to be at any point in time? And over time, what you've seen in this decade, I mean, Bitcoin is now 12 years old. Over the last basically decade, a shift in thinking. And in particular, I think between the last bull run, the 2017 bull run of Bitcoin up to 20,000, almost a 90% pullback, and now we're somewhere around 50, 60,000. The difference is that you have a group of people buying into this monetary policy and this structure, saying maybe it's not such a crazy idea. So that's what Bitcoin is at its core. It's this piece of software. It's an accounting ledger. It's something that everyone globally can participate in and have complete transparency into the set of rules. And Ethereum just layers on top of that a different set of rules. The block times happen at different intervals. They're roughly 15 seconds instead of 10 minutes. The inflation schedule is a little bit different. It doesn't have a hard cap. But the biggest change between Bitcoin and Ether, again, is that functional programming language at that base layer. That was the secret sauce of Ethereum, was to create something that's very flexible for developers to run with, to take torches and say, you can build anything you want. The design space is super wide. You want to build lending, you want to build decentralized finance, you want to do a central bank like Maker, you want to build an exchange, you can do that all on Ethereum. And so that's basically these two different camps. And we refer to Bitcoin now, the narrative has turned to store of gold or digital cash. It's kind of turned into more digital gold. And Ethereum is now this smart contract platform, which is like an operating system, right? It's iOS. They're creating the toolbox and this design space, and then developers can build whatever application they can imagine.
Yeah, well, that's a good description of the two pieces and how they differ. So I know a little bit about the kind of there was kind of Ethereum that came out was kind of the I forget what they call the first version of Ethereum. Now we're in kind of Ethereum 2.0. Like what's the difference between the two? Is it just a safety feature? Is it more functionality? What have they done with the changes there?
So Ethereum's been live now for just under 6 years. We are currently running all the applications on ETH1, Ethereum 1.0. I mean, it kind of was just called Ethereum until Ethereum 2.0 was around the corner. And there's kind of a couple unique changes. One is to address scalability, which is to allow more transactions to run through this network at any point in time. Right? You want to have more activity. You want to welcome that activity. How do you do it? Well, we need to have more transactions per second. But this is a hard problem to solve. We're not just talking about turn up a knob. You want to do this where you don't trade off the central ingredients to what made this blockchain special, that it was decentralized, that it had global participation. You don't want to centralize and concentrate that trust. So this is a hard problem to solve, to just scale up a network. It's easy to say, hard to do. The second big change here is that the mechanism for security is changing. And so currently, Ethereum uses proof of work. So this is the same as Bitcoin. You've got computers around the world that are running some electricity and computing hardware in exchange for validating blocks, pages of the ledger. And Ethereum 2.0 removes that commodity from being external to the network, right? The electricity and computing hardware, and says now what you can do is we can program the native token, Ether, into effectively a bond with the protocol. And we can take a round robin, set of turns validating transactions. And so what's happening here is that instead of the commodity being burned external to the network, and the problem with that being you have an unfair advantage if you have free or near free electricity. I'm in Toronto. I pay 12.5 cents a kilowatt hour. I'm not mining Bitcoin or Ethereum here.
Yeah.
And so the problem with that system is that you don't necessarily have alignment between the security and the validation of the network and the users and the token holders. What proof of stake does on Ethereum 2.0 is it aligns those incentives where the token holders and the users of the network become the validators. The commodity now goes from being external to the network to internal to the network, and that's what you're putting at risk. In proof of work, if you're a jerk and you validate incorrectly, you propose bad transactions, your block won't be accepted, you don't get the new Bitcoin or the new Ether reward.
Yes.
Right? So in theory, you're like, well, the electricity cost me a lot of money to waste for that period. I should just validate honestly. In proof of stake, what happens is the thing I would lose is a portion of the native token, the Ether that I've put up at risk to the network as the bond. And so those are kind of the two things that are driving the heart of Ethereum 2.0. And it's extremely exciting. It's a slow transition. So you actually have both networks live right now.
Okay.
But there's no functionality on the Ethereum 2.0 network yet. It's just very, very basic, very, very wireframe.
Got it. And so does that when that? I mean, I assume there'll be a full transition at some point, or will some things still be built on Ethereum 1.0? Are they going to? Is everything get? Yeah.
It's going to take time. I mean, these are extremely difficult problems to solve, and at this point, you have. Ethereum is approaching a $500 billion market cap. This isn't a small little project. So you could think of this like Ethereum 1 is an airplane flying midair, which at the time when ETH 2 went live, it was probably a $150 billion market cap. And what you're trying to do is build a second airplane mid-flight.
Yeah.
Right. And over time, we need to transfer all the assets, all the smart contracts, all the capital, all has to switch between these two networks. You cannot afford for this plane to blow up. We can't have something bad happen. And so ETH 2 rolls out in a few different phases. Phase 1 is just a wireframe. It basically just validates its own existence. And over time, you'll have smart contracts on ETH 2, right? Which is just the ability to run various pieces of code and software. And all of the applications on ETH 1 will migrate over. And you'll also have higher throughput through something called sharding, which basically just means you're going to break up the transactions into different groups and be able to validate more if you're not asking the entire system at any point in time to look at everything. You're going to say this group can look at this right now, that group can look over there, and overall we can start processing, much more higher throughput.
Yeah. So go ahead.
So clearly, I mean, this is in use now. I mean, this is clearly a validated technology. Why do you think, when it comes to the investment space, why do you think people are still looking at all cryptos, kind of bunching them together, lumping them together and saying this is strictly speculative investment still, when it's clearly has function to it?
I think it's still very much a new asset class. It's hard for a lot of people to wrap their heads around. I think the narrative of Bitcoin is very simple. And so investors are usually first touching an asset like Bitcoin. It's, the biggest brand, biggest by market cap. The narrative is very simple. It's digital gold. It's got this kind of skeuomorphic design. And so it seems like the thing that, okay, let's buy some Bitcoin first. But you're right in that people lump all of the cryptocurrencies together because, to be fair, the asset class moves up and down. Like, it's all very correlated directionally. There's not many days where you have Bitcoin that goes down and Ether goes up. Over time, I think you will see the assets untether. And you'll see that as people start to recognize that there's a unique value proposition to all of these assets. And I don't know if that's now, I don't know if that's 6 months down the line or 5 years. I don't think it matters. I think what matters is that people are getting used to this idea that the technology is here to stay. Right. And as I was saying before, in 2017, a group of people who wrote off this idea of algorithmic or software-based monetary policy are saying after a COVID world, right, and seeing what's happening being proposed by the Fed and Bank of Canada, doesn't matter which nation, that maybe it's not such a crazy idea. So people are digesting this idea. They're starting to participate. And they're starting to do their homework. Whether it's because they heard the buzzword NFT and they're trying to figure out what an NFT is, or they're hearing the buzzword DeFi, decentralized finance on Ethereum. People are starting to read, and over time, they are going to get smart, and they're going to want more and more exposure to these assets and recognize the technology is here to stay. It's not going away. These networks are mature. They are becoming very battle tested, and it's still a really exciting time to be investing, versus in 10 years. There's still a lot of growth for all of these technologies.
Yeah. Yeah, so I got 100 questions, but I think as I think about it, I mean, the ones that come up all the time with clients is, I guess, how safe is it? Is one of them. Obviously, I know you're gonna give me that. And the other one is, why is Ethereum?
I'll give it to you if you want me to give it to you.
Of course I do.
You tell me if you want me to get that answer.
I want to hear it. But the other one is, why is Ethereum easier to use than some of the others?
So let's bucket them and first talk about security.
Sure. Yeah.
And I think it's helpful to understand kind of the history of how these assets have been secured, because then we can put it into context of where we're at today. If you go back to the early 2010s, 2011s, these were extremely difficult assets to secure. I wasn't even on the scene yet. I show up when the world's biggest exchange at the time was called Mt. Gox. And essentially what you had is one platform custodying the asset on your behalf. And people can think of these assets not as something physical. There's nothing to touch. What you're really securing is the password, right? That's the question, is who has the password? And the password isn't dog123. The password is a string of letters and numbers that cryptographically relate to a public address. And so to visualize this in your audience's mind, think of an Excel spreadsheet. Now, we all know that Ben knows that he's sell E12. And we can see how much Bitcoin he has. We may not know that E12 is Ben, but we can all see that it's in this public database. The question is, who can move that Bitcoin off of E12? And where do you secure that password? And so in the early days, it was largely held pretty much by the exchanges. There was some very basic software. Bitcoin QT was around back then. Dreadful software to use. I don't recommend anyone tries it. But people would custody the assets on Mt. Gox. And the problem with that is, well, we saw what happened. In late 2013, there were rumors that Mt. Gox was insolvent and that their security had been breached. And then I think it was confirmed in late January or February of 2014. And all of a sudden, hundreds of millions of dollars evaporates. And at the time, that was basically the market cap of Bitcoin. It was 50% of all Bitcoin in existence, sub-billion-dollar market cap. The numbers I'm not 100% sure on, but I'm close. And well, that doesn't work. We don't want to custody it at an exchange. And in the next few years, the evolution is hardware wallets. So people get these little USB keys. I mean, they look like USB keys, whatever. And these things are basically just securing the password. So same thing. They create a public address. You could send the asset, to that address, and the password would be stored or signed on the device when you wanted to move those funds. There's a different set of risks to people who want to take possession of these assets. A lot of people say, why would I buy an ETF, or why would I go and buy Bitcoin through some kind of structured product if I could just buy the asset myself? And there's a pro and con to this, right? If you hold the asset on your own, these are true bearer assets. There's no undo button. If you don't back up your USB key, if you don't have the private seed, it's basically a set of words. If you don't have duplicates of it and it's in a safety deposit box, or it's in multiple locations because your house burns down. I mean, there's things that can happen where you lose access to the asset. And it may be one thing if someone has $1,000 in it and their life won't go to shambles at $1,000, but as the asset appreciates, the target or the concern for how the security is being handled, of course, goes up. Now, best practices for the exchanges has evolved. And starting in kind of the 2017 era, you started to see real custodians emerge, institution-grade custodians. And you couldn't get an ETF approved in 2017. There were a number of filings with the SEC. The SEC rejected all of them. And now what you have is those custodians, right, are trust companies or qualified custodians, depending where in the world you're located and how it's worded, whatever. But you have best practices where those assets are not just one person on a platform with the private seed or the PIN code, you know, where they can steal the funds. There's a series of controls in place to ensure that when you have billions of dollars, in some cases tens of billions of dollars, sitting on some of these platforms like a Gemini or a Coinbase in the US, that it's not one person who's signing that transaction. Again, it's a series of controls of knowing it took multiple people to sign off, multiple people had to go through fingerprint scanners, retina scans. I mean, this sounds sci-fi crazy, but we're literally talking about, I mean, in the Gemini scenario, I think they just passed $35 billion of assets under custody. So, you know, there's real risks. And so that's kind of, in terms of security, how people have to look at it. And so they can decide to go on an exchange and have a platform custody it. They can go buy a USB key, or they could say, I'm going to buy a structured product, you know, an ETF, a closed fund, whatever, and say, I'm going to get my exposure that way. The nice thing about where we're at today in 2021 is that clients who want exposure to the asset have options. And historically, they haven't had options in this asset class. They've had to choose how much risk they wanted to take and be forced onto this part of the spectrum. The highly technical, highly risky fly-by-night exchanges was the only way to do it. And now a new group of people can say, I don't want to do that. I'm just going to go buy a structured product. So in terms of security, that's where we're at today.
That's a great answer, and I think about that too when you describe it in that format versus, you know, if you put your money in a bank account, what does the bank do with your capital? And people don't even think twice about it. But, you know, a standard bank account wouldn't have the same security levels that this would, right?
They're just different. I mean, they're different kind of assets. Most of the custodians now are not allowed, I don't think, depending on where they're regulated, allowed to lend out those assets on the back end. There's no fractional reserve allowed here. Whether that changes over time, I'm not sure. But there's just this spectrum of risk, and people can decide where they think is appropriate for them to fall and what they're trying to achieve in their portfolio, in their learning. I mean, there's something nice about holding the asset on your own. You learn something. You get to touch the point of the technology, right? Which is that it is a bearer asset. You can take control, but it may not be appropriate for everyone.
Yeah, for sure. And the other question was, why is Ethereum easier to use, and why is it kind of leading? It seems like most developers want to develop on ETH, and from what I understand, it's one of the more expensive places to transact. Is that correct, both of those?
So let's start with, why do people want to build on ETH, or why is it easier to build on ETH? Now, again, going back to Bitcoin doesn't have a functional programming language at the base layer. Ethereum has something called Solidity that's part of it. And so you can't build applications on Bitcoin. It's just not possible, right? I can send Brian to Ben 1 Bitcoin. You can send it back to me, but I can't ask the network to send it on my behalf later. And so when people refer to a smart contract platform, you can replace the word smart contract with the word software. Right? And so I can ask the Ethereum network to send Ben an Ether next week. You might have to do it in kind of a funny way, but you can ask the network to do it. It's capable of doing that. And so developers build on ETH because the network by design is able to do those things, whereas it isn't on Bitcoin. Now, in terms of ETH versus other smart contract platforms and where it's easier to build, that kind of depends on what the developer wants to achieve. The reason that so many people are building on Ethereum is that you have this rallying of mind share. You've got capital formation, you have tooling, you have infrastructure. And you could think of this like a city. Ethereum is the Manhattan right now. It's where there's the most infrastructure. Now, the infrastructure may be a little bit old. It may be broken down a little bit. It may not be as highly advanced as someone who wants to build a city from the ground up in the year 2021. But there is enough infrastructure in New York that if you're a developer, you probably want to be where the most capital is.
Right.
And so right now, if you think about what is part of this Ethereum ecosystem, well, to make it function, you need a way to view the blockchain, right? Block explorers. You need wallets. Ethereum has multiple wallets, whether it's hardware or it's software based in the browser. Ethereum has lots of those. There's decentralized exchanges. So someone has built the decentralized exchanges, which depends on the wallets, which depends on the block explorer to function, right? So someone can now build the exchange. Then on top of that, someone can build a lending protocol. And the lending protocol, again, requires the wallets and the block explorer. Then you want the capital on the exchange, because without the capital, no one wants to come and use that exchange.
Yeah,
and so you can keep going down this line and realizing, as a developer, of course you want to build on Ethereum. That's where all the activity is happening. And if you don't want to start from the ground up and say, I'm going to move to the middle of Nevada, look how cheap it is to build infrastructure here. It's free land. I mean, sure, it's free, but there's no customers. There's no gas stations. There's no restaurants. You know, this is that saying, oh, no one goes to that restaurant anymore. It's too crowded.
Yeah.
And so Ethereum kind of suffers from this problem. And so the reason people are building on Ethereum is because that's where the most infrastructure is. That's where the mindshare is. That's the capital formation. That's where the tooling is. Now, the problem with this is we have everyone lining up right now at basically the Supreme Court, right? Everyone is asking that main chain, that base layer that's super, super, super secure, to confirm some activity that they do on the network.
Okay.
And so what happens is there's only so much bandwidth on Ethereum, right, per block, per page in the ledger, for transactions to be included, right? This is part of the scalability of ETH2. And so right now, as more and more people want to use this network, NFTs became big. There's still a lot of trading on decentralized finance, platforms, and then there's yield farming, and there's lending. I mean, there's so much activity happening, and there's only so much room on this highway. And this is like a toll highway. It's like a road, and all the cars are trying to get on the road. And the question here is, what happens to the people who get priced out of transactions? And your comment of it's very expensive to use, absolutely. But the question is relative to what, and relative to what activity? Like to who and to what activity is probably a better wording of it. Now, if you're trying to buy a $10 NFT, right? An NFT is just a piece of art, digital art that lives on a blockchain. Well, it doesn't make sense to pay a $10 transaction fee to be included in this blockchain, right? To have that secured by the network. That activity has to go somewhere. Now, what we describe is you've got a layer 1 and then a layer 2. And so the network activity can go one of two places. It can stay on layer 1. Actually, it can go 3 places. It can stay on layer 1. It can go to a competitor network to Ethereum, which doesn't have any of the capital formation, mindshare, or infrastructure, although it's getting better. To be fair, it's getting better on other networks. Or it can move to something called a layer 2. And a layer 2 is this idea of building, on top of Ethereum, another network that uses a lot of the same infrastructure, where you could flip a switch and say, I want my transaction to now go through layer 2 instead of layer 1. And think of this as the base layer is that superior court, Supreme Court. And what you're doing is you're saying, hey, your $100 transaction is more similar to, you got a parking ticket. Well, when you get a parking ticket, you don't need to go to the top court, in the US. That's just not appropriate. You can go to a regional court. And so layer 2 is more like having all that activity move up to a place that's a little bit less secure. You're going to go to the regional court. The transaction fees will be much lower. And maybe that regional court is specific to the type of activity you want to do. It's been customized for that type of transaction. And there can be multiple layer 2s. And then every so often, those layer 2s will print a state of their network back to layer 1 and say, here's what happened in our regional court. They pass that information back to the ultimate court system at that base layer, and everyone is happy. So that's kind of what's happening right now. It's frustrating as layer 2 hasn't fully evolved yet. It's, this stuff's work in progress. It is pricing out a lot of activity, and that activity is really struggling. Where can they go? Where is it appropriate for them to be? They will, over time, they'll end up on layer 2. They'll go to another network. They probably don't stay on that base layer of Ethereum. They'll find an appropriate home for those transactions. So even though it's expensive because there's so many people who want to use this network.
That's fair. That makes sense. So I'd like to maybe ask you a few questions around your relationship with OSC and IROC around kind of that digital relationship. I know you've been active in trying to help understand their understanding of how this fits in. Maybe you can describe that a little bit. I know, Scott, you had a question about that specifically. Maybe you want to go ahead and ask Brian that now.
Yeah, well, I think we have a good sense of, I think we have a basic sense of Ethereum and the technology behind it now. So I think I'd like to switch gears and kind of talk about the investment opportunity and the finance side of it. You know, us being investment advisors, and coming from the traditional banking model, there's a lot of restrictions around how people can invest in this in their portfolios. And I just wanted to kind of get your initial thoughts on how you see kind of that banking world and how people, the everyday person, will be able to invest in these types of assets moving forward.
So I think right now what you're seeing is, of course, a ton of interest from investors who haven't participated historically in this asset class. And that new set of investors is looking for appropriate access points. Some will go out and make accounts on crypto native exchanges. They can go do research on where they think there's best practices, transparency, a list of assets that they might want to touch. They can see, what the fees are and decide if they think that that's an appropriate venue. There's also structured products emerging. Now, regulators, of course, are not going to just set the dial to a free-for-all right out of the gate or ever. That's part of their job. And they're going to vet these assets to make sure that they are appropriate, that there's daily liquidity before they approve an ETF. And so now what you have is a Bitcoin ETF, you have an Ethereum ETF. We had for a few months a number of closed-end funds. Problem with closed-end funds being, quickly for most people, that you're not necessarily getting your redemption or your purchase at the net asset value of the asset you're trying to purchase. So that's historically been a problem. But now we have ETFs, so you do have daily liquidity at NAV. And so again, some investors can say, I don't care about the other assets. I really just want the top two. I want Bitcoin, I want Ether, I want some combination of those two things, and I'll do it through a structured product because it fits inside a 401k or TFSA, RSP, whatever the registered account is for your audience. And they'll buy it that way and say, someone can abstract away from me the custody. I don't care. I don't want to know. I just want to know that I have exposure directionally to the asset. Long term, the question is, where is this going to evolve? I think that there is going to be a lot of demand for people to participate in DeFi, participate in the loans and the yield that they can generate off holding these assets. Instead of them being unproductive commodities, you have them turning into yield generating instruments. And that's really exciting, right? Ethereum is transitioning from proof of work to proof of stake, and you're going to take a unproductive commodity and be able to generate yield while having exposure to that asset. How people find access points to these things 1 year or 5 years from now, I'm not sure. I do think you'll see the crypto asset exchanges, the native crypto asset exchanges, get better with their offerings. There's going to be more regulation that firms up how custody works, what their relationship is going to look like with the clients, and people will be more comfortable with interacting with those platforms. You're also going to see non-crypto native exchanges start to expand and dip their toe in the water because the demand is clearly there. And you've seen this with the big banks, right? BNY, JP Morgan, they clearly have demand for these assets. And so they are starting to get smart and say, it's time to look into what would custody look like? If we wanted to offer that to our clients, why are we sending them across the street? We should figure out how to do custody. We should figure out how to create institution grade products. And I don't know what the timeline is going to be for them to offer it out to people, but it's going to get there. The demand is just too strong for people to ignore.
The interesting part, and I don't know if I'm going to get in trouble here, but the interesting part is like one of the key assets of crypto, and from what I understand is that its main function is to help cut out the middleman, right? And whereas you're talking about how they're going to transact with big banks and whatnot is part of the mandate of, or not mandate, but the advantage of these platforms not to kind of cut out those, like the middleman, the banks, the advisors, stuff like that in the future?
I think that the core, the heartbeat of these protocols is that a token can remove the agency. And you are going to see that happen. You're going to see the agency get completely commoditized. And to help people visualize how this plays out a little bit, here's an example. The biggest exchange in the world, some of the biggest exchanges in the world, I'll leave out names, but they might trade, let's say, a few $1 billion a day, right? Total sloshing around their exchanges, that's the daily volume. Now, to facilitate that amount of trading, there might be 500, 1,000 employees. There's a lot of compliance. There's registrations in various jurisdictions to facilitate that trading, right? Security, controls, programming, all that is required to facilitate, let's say, $3 billion a day of volume. Now, shareholders, of course, are getting passed on the cash flows of what they make on, whatever fees they can clip after, you guys know how this works. Now, the question is, when you have Ethereum and you build something like Uniswap, Uniswap is a decentralized exchange. It's a piece of code that lives on the blockchain, and you can swap between various assets on the Ethereum chain using Uniswap. Now, it's easy to say as an investor that you want to buy the picks and shovels, right? I don't want to bet on the tokens. I want to buy the picks and shovels. But the point that we're talking about here is the agency. And the question is where to bet. And my statement was the token is going to remove the agency. And so what Uniswap has is at first maybe $1 million of volume a week, nothing too significant a couple years ago. But Uniswap has grown to the point now, the biggest decentralized exchange, where they may slosh around $3 billion a day. Now, Uniswap now is matching what the centralized exchange is doing in terms of volume. But here's the key. You can own the Uni token, right? So this is a token that allows users to govern the protocol, what assets might be approved in a certain way, how the fees work on the platform. And it's possible, it's not there today, that token one day allows the Uni token holders to share in the fees being captured by the liquidity providers in the various pools. And so to connect the dots here, what that means is, would you rather own a token where there's no overhead, there's no employees to facilitate $3 billion of trading and capture fees that way? Or do you want to invest in shares to a company that has 1,000 employees, regulation, overhead, doing the same volume? To me, the answer is obvious. The token is the way to go. And so that token completely removes the agency. Now, this is an extreme scenario. It's a really exciting one, and it's one that I think is very real and going to continue on this trajectory of just exponential growth. There is still going to be a need for these centralized platforms for either a set of users who aren't comfortable touching a decentralized exchange, or they have certain AML, KYC requirements. They're an institution and they need to hold the asset in a certain way. And so you're going to see these two worlds exist for a very, very, very long time. And they each have their pros and they each have their cons. It's expensive to transact on Uniswap. It's very cheap to transact on a centralized exchange. Less custody risk on Uniswap, some custody risk to a centralized platform. So over time, people are going to weigh these two worlds on platforms to decide how is this going to shape up. It is very exciting, but I do think you're going to see a lot of the services and the agency get removed. And the last very short example I would give is that you could now look at around Ethereum and say, well, if you can program this money on chain to do all sorts of things for you, and there's 10 different lending applications and 10 different flavors of tokenized US dollars, well, someone can build a bot now that will just move those tokenized US dollars between various lending platforms at any point in time to maximize the interest rate in a way that traditional finance has just never seen. And we're talking, a user at home essentially can go and buy that product for the cost of, $5 or $10, the transaction fee, the gas to facilitate the entry point and the exit point. And that's it. They hit the go button and their USD might be making 21% because that's just how the algorithm is going to work. They don't need an office and staff and people. The code is going to do that on their behalf. And they maybe can set parameters of how it works and exchanges they're comfortable with or platforms that they are or they aren't comfortable with. And this is not to say that there's no risks to this. There's a different set of risks. Has the code been audited? What kind of audit? How many eyes have been on it? How battle tested is it? What's the liquidity like? There's a list of things here. But the point is, this world is coming, and it's one that people, I think, have to be aware of. They should be aware of because it's a little bit scary, but it's also really exciting because it enters new opportunity.
Yeah, that's, I mean, I think that's an amazing place. I think that the whole thing and the whole attraction to it is, I mean, there's a lot of good potential for people to either save money, make money, be safer. I think that there's tremendous opportunities, and, the further we dig, the more questions I think that there are to try to understand where and how this is going. And so I guess as I sit to and think, I've had certainly understanding from multiple CEOs of the banks and heard them talk about what their views are on it. And, I guess if I were sitting there, I'd think this is a unique opportunity potentially for us to pay attention to it. Is traditional finance looking at it? I mean, you mentioned JP Morgan, but that's kind of, that's traditional. How do we manage assets like we manage commodities or something like that? They're thinking about it that way. But are these banks thinking about how they integrate something like this into their system, or is nobody even there?
My prediction would be no.
Okay.
They're probably looking at how to do very basic offerings to their clients, which might just
Got
mean serving the demand for Bitcoin, Ether, letting them hold it inside of an account. So that basically means figure out custody. In terms of connecting into DeFi, it's really tough because in theory, someone can just route around the bank and interact with it without the bank. So what was the bank's role in that? The bank can't build any of those products. They can try. The reality is you have 100,000 plus developers now around the world who are going to beat the pants off of whatever you can develop, and it's going to be better. It's going to give better rates. It's going to be more battle tested. It's going to be audited in a better, you just can't compete with that, right? And if you look at the early days of the internet and you say, well, someone needs to create a really secure mail service, is that likely going to be, the post office, Canada Post? Or is it going to be a young, very nimble startup? I'm going to bet on the very nimble startup. So banks are in a bit of a tricky scenario, right? There's a lot of bureaucracy. It's hard to be nimble and innovate, and those people are not in-house. They might have some great people in-house with security and technology already in place, but the people who are really the most exciting for me to watch in the space are the young developers. When you go to a developer conference, doesn't matter where in the world it is, and you see a couple thousand people, right? The biggest events are called ETH Global events. And you see a couple thousand people working from Thursday night to Sunday, coming together from literally around the world. You'll have people who team up together, who you have this person who came from somewhere in Asia with that person from London and this person over in the US saying, oh yeah, we're all really interested in how you could do, variable rates in a smart contract platform that uses Maker, a central bank as its back. There's all this crazy thinking going on. Those are the people who I just can't imagine betting against them. And so I think it'll be interesting to see what traditional finance and banks try and do here. My personal focus and the focus at Ether Capital is not really to pay attention to what the institutions want to do. It's to bet on those developers and say the next set of applications here, right? We're going to see Web 2 emerge all over again just in this world. The Googles, the Amazons, the Facebooks, those are being created now in this new space. And there's so much design space wide open that the opportunity to invest in or participate in the growth of those is really unfathomable almost. And it's really inspiring, again, to go to these conferences and see the amount of ingenuity that people have.
Sure. So just switch gears a little bit, just about central bank digital currency. Obviously, I'm sure you're quite familiar with that. Obviously you see that most of these central banks are trying to figure out how to do it. And so where would they be building on? I know that the US is testing, they say something like 7 digital currencies right now. Where would they be building those? Do you have any idea on that?
I just want to comment first on the difference between a central bank digital currency and actual digital or cryptocurrencies, because they are different.
For sure.
And they're different because when people say, well, will those central bank, those CBDCs compete with Bitcoin? My answer very quickly is absolutely not. People aren't buying Bitcoin because they want the flexibility of the blockchain and they want, global money. I mean, fine, maybe there's a little bit of friction that gets removed. People are buying into Bitcoin because they want a monetary policy that is untethered to a central bank. That is why people are piling in the second half of 2020 and, and still going on today. It has nothing to do with the friction of that money or the velocity, the potential velocity of that money. Central banks again, they're going to maintain the monetary policy as they see fit. They're not going to give that up. Maybe they tweak it around a little bit to make it more transparent. I don't know what the governance is going to look like, but that's not the value proposition here, is a better monetary policy.
Yeah.
What they're trying to do essentially is have a more direct relationship with the consumer. So instead of the relationship being a central bank to a commercial bank, and then the commercial bank has the relationship with the end user, now the central bank can have a direct relationship with the end user. And then the question is, what is the need for the commercial bank? Now, the commercial banks I don't think are going away so soon, but I do think that the CBDCs have this potential to have more frictionless distribution. If they wanted to do bailout money, they could more easily do it if everyone had a digital wallet at home. They didn't need the commercial banks to distribute it. I always argue, a little tongue-in-cheek, that money's already digital. I mean, less than 10% of the money supply that exists right now is in the form of paper and coins. 90% is transactional through Visa, debit, ACH, whatever it's going to be. So I kind of don't get too caught up in the central bank digital currency narrative. Now, what platform they build and test, I'm not sure. I've had a few conversations with people at the Bank of Canada to try and suss out what they're thinking. If I were an advisor there, which I'm not, but if I were, I think it would be important to look at something that either was based off of Ethereum or compatible with Ethereum, because I think that what will happen is whatever central bank, outside of probably China, whatever a central bank wants to use, there will be a point down the line that they may want to plug into this open infrastructure. And you've watched this play out in the late 80s and early 90s, not about money, so the stakes weren't exactly as high as monetary policy, but you did see the battle between intranets and internets. Closed environments controlled by corporations, open, politically neutral, borderless pieces of technology. And in the early days, Microsoft and AOL said, we want to control the experience. We want to be able to allow people to dial into our servers, and we'll serve out content, music, games, media, whatever it is. The problem is that the developers can't build in that structure.
Around that.
They can't do it. And so if you want to build a lending application, if you want to build DeFi, well, you're not going to do that off the Bank of Canada dollar, because you're not going to have permission to do that.
That's right.
All that activity is going to float its way onto Ethereum, right? The open, this is the internet. This is the open, borderless, permissionless, politically neutral structure. And so at some point, my guess is that all the central banks will realize they're going to need to make themselves compatible with this over here. And the question is, if you have the central bank, you have Bank of Canada, who builds on one platform or their own, and you have the ECB, the European Central Bank, build on something entirely different. What happens when they want to open a swap between the two banks? How will they do that? They are going to have to choose. They can't. They're going to have to choose some politically neutral layer to move between. And my view is that is probably going to be Ethereum. And so I think central banks can definitely say that they don't think it's appropriate yet to use the open public network. Totally fine. Take the code, run it in a sandboxed environment, do a closed version of Ethereum. You've seen lots of people do this already. And that kind of future-proofs where it's going. And that if one day they decide to flip a switch, they can plug it in a way that they think is appropriate. So that would be my advice, would be to just think about what's going to happen in the next 10 years here. And are you going to design a system that's not compatible with the rest of the world? And everyone gets siloed again. I mean, the whole point of these blockchains, if you remove the money idea for a moment, is you've got all these databases around the world that are siloed. Right? No one can talk to one another. And so you end up with the Swift network, which everyone hates. Crazy expensive and crazy, which everyone hates. And the point is, we all need to plug into something that unsilos that data. And we can permission that data however we want. We can set parameters to it. We can whitelist addresses. We can use ZK snarks, zero knowledge proofs, to shield the information to parts of those transactions. That technology is going to evolve and come to fruition in the next 3 years. And so I think central banks are going to have to look at what the future is going to be and how much risk they want to take if they want to run off on their own.
Yeah, I mean, I think that central banks still care about the one thing that they can control is really, can they control inflation? Can they control rates? And the one thing they can definitely control inflation, if they do digital currency, if they're going to jam money into your bank account, you're going to bet that's going to stoke inflation. So, I think they want to have that. They've lost that lever because they've been just funding money to the commercial banks. Commercial banks haven't been lending it out, and so that's why inflation's kind of stalled here. So interesting. That's an interesting angle, and I think that's a fair point. I believe it's highly unlikely that they silo, particularly where all of the central banks have the same school of thought, same economic school of thought. So, I think they'd come together with a similar angle. So that's a great point.
We have seen, though, this narrative kind of has played out already, just not with central banks. What you had was, in 2015, a narrative running around the ecosystem called blockchain, not Bitcoin. This one, took me 5 years to mallet this thing away with a hammer, because I would constantly say, you can't strip the token reward outside of a network where you want untrusted parties to transact with one another. That is not possible. And everyone said, no, the banks are going to do it. I'm like, just trust me, you can't, this is not possible. And so what you ended up with was a number of corporate projects that wanted to do blockchain, not Bitcoin. And you had R3, R3 had this project called Corda, you had IBM in a project called Hyperledger, you had JP Morgan in their project called Quorum. And again, they're all creating their own little silos and saying, everyone connect into us. And everyone said, we don't want to connect into you, we don't trust you. And all of these projects basically failed in a spectacular way. IBM basically laid off their entire staff for Hyperledger. They spent hundreds of millions of dollars. They built absolutely nothing. I'm being a little harsh here. But the reality is, over time, they've realized that they're just building the structures we already have. The whole point was to unsilo those databases. And the only way to do it is you have to have something politically neutral. And so I just draw this parallel. I'm just going to watch this play out again, whether the central banks first go down the path of trying to create their own silo databases and then later realize they have to plug into something politically neutral. Maybe. But I do think that it's important to look at how this is probably going to shape up in the next 10 years and design that way.
Yeah, no, that's interesting. I think it's going to be very interesting to watch, see how that plays out. Maybe a little bit of comments just around, we've briefly touched on kind of tokenization. Some of these companies like T0 and some of these other places have, put corporations, they've tokenized corporations and put them on their superhighway. So as these, most seem to be tokenizing on Ethereum. Is that the case right now?
So T0 is not an Ethereum-based project. Now, a disclaimer here: I haven't read about T0 in probably 7 years. This is Patrick Byrne's project, right? Yeah. This is over. He wanted to build this.
Overstock,
Overstock.com tokenized T0. Yeah, okay, I got it. The problem with tokenizing things is, first of all, everyone wants it. I think everyone agrees that we should have liquidity to these illiquid assets. Everyone wants that to happen. The problem is that you have a set of regulations that make this extremely difficult. And this is not, by the way, a fault of the regulators. What I'm commenting on right now is that these two worlds are a little bit like oil and water, and they don't really mix. And the reason for this is, let's pretend we wanted to tokenize some real estate. Okay, and T0 is going to tokenize some stock, whatever. But let's talk about real estate for a moment.
Sure.
Now, if you live in whatever city, the city doesn't know what the blockchain is. The city doesn't care what the blockchain is. The city knows that there's a land registry, and that's where, the deed, the title, that's where it goes. And they look to that place, that oracle, for the information of who owns that property. Now, let's say that we take that deed and we want to tokenize it, and we're going to put it on a platform, and we're going to transfer it through this platform. Well, here's where we hit the first snag, because there's the divergence here of a decision that has to be made. If Ben wants to remove the deed to his house off the platform, right? You want to take possession of that actual token that represents the deed, and you put it on a hardware wallet. Now, my question is, what happens when you lose by accident that hardware wallet? Now, if the answer is no problem, the platform can reissue you the token, Well, then what you basically said is that this is no longer a bearer asset.
Yeah,
because someone has a God key, and you basically removed the blockchain from this equation. You just said, we'll make it digital and we'll have it on a platform. But I mean, AWS and Google Spreadsheets is also digital and super fast. And so the question is, can they reissue you the token? Now, if the answer is that they can't, and that it's truly a bearer asset, and you can remove that deed, and it can sit on your little device, it unlocks a lot of potential of what you can do with that deed. So you take something like Maker. Maker is essentially a decentralized central bank that lives on Ethereum that allows you to generate your own money against a collateralized asset. You could unlock that deed and say, I want to create my own loan against this deed to this property, and I can do it because I have a tokenized version of that deed, and there's some oracle that says, yes, that's an acceptable form of collateral, and we know what the value of the property is. You can do that. But you hit a snag the second that all of a sudden, well, don't worry, the platform can just reissue the token. If you lose it, all of a sudden, that can't be collateral in a decentralized system. That doesn't work anymore. Now, there are people who are trying to tackle this problem, and they will solve this problem over time. But currently, as it stands, the reason you haven't seen real estate on the blockchain and securities on the blockchain, everyone, these are buzzwords that traditional finance is constantly talking about. I always go, no, you can't do those things yet, and it's because this bearer asset problem. It's the second that you remove the ability to lose the token because it genuinely got lost. Well, then you didn't need a blockchain. You just all you were saying was, let's bring liquidity to illiquid assets and have it trade on some secondary marketplace, right? Someone registered as an exempt market dealer, and they've got another exemption to operate a secondary marketplace, and that's great. I am all in favor of that happening. Just understand the difference between what the blockchain and crypto world is trying to do versus database with more liquidity. And I hope that they do. I hope that oil and water one day find ways to commingle, because I think that's when things get really interesting. I just don't think we're there yet. Yeah, that's it certainly seems like the almighty thing that many people are chasing, and it's a good description of the challenges around that. Maybe you can tell, I mean, this has been a great discussion. Maybe you can tell me a little bit about Ether Capital and what you do there, and what the objective of the company is. I won't say too much about Ether Capital, but high level, we're basically a Web3 ecosystem investor. We invest in things that are Ethereum based, protocol token, application layer tokens, other core pieces of infrastructure. Staking is really interesting to us as an organization, and we want to be that group of people in the capital markets who have a very clean and focused thesis on what's going to happen in the space 5 years out. We're not momentum trading assets. We really have a very deep understanding and respect for the assets that we see shaping up, and we'll ignore all the hype, and we'll just say what in 5 years is investable. Like, that's what we want to hold. That's what we want to bring to the capital markets and say, this is the access point. We can be the beacon for you to follow. And amidst all that noise, here's the signal, and this is the group of people you can follow.
Awesome.
So you're
awesome.
saying you
Very
don't have a big position in Doge, is what you're saying.
I actually was, I think, one of the first probably 100 people who were mining Doge or had Doge back in late 2013 or the first day of 2014. It was one of my most favorite subreddits, actually, because the memes that would be on Reddit in Doge, Doge was not trying to be serious. And even to this day, one of the things that Dogecoin has different than Ether and Bitcoin, there's so much tribalism in this space. Dogecoin everyone loves. There's you can't hate on this. It's not trying to displace anything. It's not trying to be serious. It's fun. It's inviting. It has a market cap of like 100 trillion, something obscene, 100 trillion, and just people like it. It's fun and it's friendly. And anyway, I don't have any Doge anymore, but I did in the very very early days.
Just one more as we wrap up here. So if people, I mean, there's obviously a lot of education that needs to be had here as far as this space in general. Where do you think is the best place for people to go to for two things? Number one, just to understand the basics, if there is a place that exists besides just Google, right? Because that could be a scary ride. And if you want to kind of keep up, like Ben and I kind of have a pretty good understanding of it, but would like to keep up, where should we also be, what should we be reading, what should we be watching, who should we be talking to, type things.
It's definitely a really, unfortunately, hard problem in the space of what is going to be that oracle. Where do we get clean, digestible information? I flipped through the other day Investopedia just to see what the descriptions were. And I thought that for the most part, things were pretty good, for that very high level, here's what's happening. I thought it was a great resource for people. At Ether Capital, we run a weekly newsletter. It's up on our website. People can sign up from our website. It's kind of a highlight of what happened in the space that week. It's not about Ether Capital. It's just about the digital asset ecosystem and the most important pieces of news. It's not necessarily learning. I would say that that's more just information. And unfortunately or awesomely, or wrapped the two things together, this space moves insanely fast. And every day there's something new that's happening. It is really hard to keep up. So the newsletter is kind of recapping what's happening in the space. You've got websites like CoinDesk and The Block that are putting out longer thought pieces on news that's happening in the space. And they also have some resources as well. And then there's a lot of great podcasts. I mean, Ether Capital, we have a podcast. Laura Shin has Unchained on Ethereum specifically. You've got the Bankless podcast. And I think people just have to go on a bit of this journey of looking for information and taking time. And there's a whole new lexicon out there for sure. And so it's hard for people to digest. But I think that ultimately there's so much alpha right now if you can understand what's happening in this space. And on Ethereum specifically, there's some upgrades coming to the network between proof of stake and something called EIP 5059, that when you put all these things together and you understand how the monetary policy is going to change, you understand proof of work, you kind of have this perfect recipe of what the price of Ether might do in the future, which is really exciting. And so it takes time for people to read about those things and think about them and then say, I understand why people are getting really excited about ETH.
Yeah. Awesome. That's, I'd hope maybe you'd come back on at some point again in the future, because I think we definitely had some, you gave us some, provided ton of information that will provide a tremendous amount of support for my clients and the rest of the audience. So I appreciate that. And I appreciate you really taking all the time. I still have a lot more things that maybe we can come back to on another day. But that's been an awesome start. And I really appreciate you taking the time with us tonight, Brian.
Thank you guys for having me, and looking forward to coming on soon.
Awesome.
That's great. Okay, that's another episode. I'd just like to say before we let you go, Brian, that so we've done 20 episodes so far. Easily my favorite one. You've been my favorite guest.
Thank
so
you.
Definitely
Nice.
want to have you back on. Yeah. So that's pretty good. Out of 20, you're number one right now. Okay, so that's it for episode.
That just means next time I have to go 2 for 2.
That's it.
Exactly.
Exactly. Okay, thanks again, and we'll see you next time.